You're a founder or an entrepreneur. You want to take your company value to 300 million, we gon' show you how to do it. Well, we got the roadmap, the aspirations. We'll give you a game plan and strategies. Seize control of your company's destiny today by tuning in to Private Capital Mastery. Yeah. Let's start the show.
Welcome back to the Private Capital Mastery Podcast. I'm your host, Brian Franco, and today we have an esteemed expert who will shed light on how project development and management are intricately tied to the valuation and exit planning of your business. Brian Monroe, managing partner of MTI Global Group. Brian is a master at project management and development who understands not only how to identify the right strategy for your business, but also how to remove the barriers holding you back from maximizing your valuation. Brian, thanks for being with us here today.
Thanks for having me.
Yeah, of course. It's going to be definitely some valuable information and in the work that you have done and continue to do. Before, I have plenty of questions, right? And would love to dive into those, but give us a little background on yourself and what in your journey, what makes you an expert, right? Let the audience know. I mean, what have you done and what have you accomplished, and just some highlights for us.
Sure. Yeah. Absolutely. So I've been project managing for about 26, 27 years now. Yeah. And number of different clients, number of different industries. So as a result of that, I've seen a lot of different things that, maybe you'd see in manufacturing, you wouldn't see in healthcare. Maybe
Correct.
You see in telecom and you don't see it in finance. So you get that kind of breadth of experience. The other thing is back around the mid-2000s, I started to evaluate a lot of the projects I was working on and realized that I was actually doing a lot of what I call project rescue. So I was actually going in after they started, they had gone off the rails, were starting to get in trouble, and I was going in and bringing them back in line and helping close them. As a result of that, you learn really quickly how to avoid getting into trouble in the first place, so that when you're working on a regular project, just a normal, you're hoping it doesn't get in trouble, but you're scoping out a regular project. You already know what to be looking for. What are the signs and the symptoms to be watching for as you put the plan together? And as a result of that, we tend to move our projects a little faster and a little cleaner as far as, if you had to look at our risk register or issue log.
So it's proactive work versus reactive work.
Absolutely.
And I love that. Let me tell you why I love that. Because in the Private Capital Mastery podcast, in the 20 years I've been in investment banking and M&A advisory, we see what doesn't work and we see what works all the time, right? And so our job and our role is typically I like to say, is to see around corners, right? And as you're walking down this journey with a client, whether it's you or me in our work, we have to know where the landmines are buried, right? Because if we move anyone in the direction of danger or harm or anything that's going to cause the business to, I don't want to say, fail, but in some segments it can, right? Fail. If you do this the wrong way, you can really damage a company. But knowing where those landmines are buried, and you don't know them until you really stepped on them, right, along the way.
Once or twice.
Yeah. So 26 years, you stepped on a couple landmines. I'll admit I have, along the way. But it's those experiences that you take with you forever, and you will never step on that same landmine again.
Exactly, because you've learned what are the signs that are popping up that I should be taking notice of when I'm still 10 feet away from the landmine.
Because there are signs. The signs are there.
Absolutely.
Right? Yeah. So let's go on a couple case studies and talk about that, because, illustrating this with case study always brings this to life. And so I'll dive into a couple questions with you here. For example, for businesses navigating valuation and exit planning, what are the common pain points or challenges associated with their projects or initiatives that that are basically designed specifically to increase the valuation. So
Probably the biggest challenge we get is resource utilization. These companies, they take a look at what needs to be done. They've got a good idea now what they think they need to do, and they take a look at the people they have around them going, well, wait a second, everybody has a full-time job still.
yeah, some a job and a half, right?
Exactly.
Yeah.
How can they possibly take on the 10 things you just identified, or that the team identified that we need to do? And so that's probably the number one challenge we get.
Yeah.
I would say the second one is if the exit, or maybe it's not an exit, maybe it's part of an acquisition or a merger. Maybe they did a merger the year prior and they're doing another one. Well, now you've got a bunch of disparate systems.
Yeah.
And it's like, okay, wait a second, we need to bring those together before we can actually move forward. So you've got that as well.
So the integration of almost a Frankenstein version of this system and that system and that system all taped together, where you're taking out the tape and you're putting these machines and systems together into one unified platform, right?
Exactly.
Which is important when there is a roll-up strategy or mergers occurring, because that ultimately impacts culture, which is a different subject, but it does impact culture. If you and I are with the same organization, but you work in that silo and I work in this system and this silo, it does cause some separation.
You would be surprised how people get attached to
Yeah.
their system.
Yeah.
And you tell them, well, we have to change that. Then again, culturally, they're like, wait a second, don't be touching my system.
That's their domain, right?
Yeah.
That's funny. So, Brian, how do these issues in these areas impact the overall health and strategic positioning of the business, especially when it comes to a sale or an exit of that business? A successful exit, let's call it.
Right. Well, we talked about the example of people getting entrenched in their own systems.
Yeah.
So when you're moving an organization forward and you have to take 3 systems down to 1, then you need to be making sure that, let's say there's a person assigned to each one, all 3 of them are part of this transition going forward, because in the event that somebody decides that this isn't where they want to be, this isn't something they want to do, you've got to make sure you've got that coverage moving forward. So that's one of the things we have to do. And from a project health perspective, you're actually, in this case, you're monitoring the health of the morale of the team itself.
So you could measure that?
Yeah, you can.
Yeah.
It's obviously more felt than anything.
Yeah.
When you walk into an office and you can just, ooh, what's going on here?
Yeah. That business intuition.
Yeah, it just doesn't feel right. But you can actually measure that. And one of the things we're doing is we're always looking at what is the overall sense of morale. Are people encouraged by what they're doing, or can you see them sort of backing off and not necessarily being as engaging as you need them to be to prepare for this exit?
Yeah. So, Brian, how do you prioritize the level of management or integration of these companies for purposes of business valuation, right? Are you doing some sort of initial analysis or survey, or what does that look like?
So I'm relying heavily on the business owner and the finance team, and if there's an investment firm involved, that team as a whole, to start setting the valuation of what these individual initiatives or projects could do. What I'm doing is I'm taking a look at the priority from a project management lens perspective, saying, all right, what can we do first, second, third? What order should we do this? What time of year is it? Who do we need available on each of these projects? When are they available? Obviously towards a year end, you're not going to get the finance team helping you out a lot.
No.
So maybe we should focus on some IT-based projects or things. So I'm looking at prioritization from a project management lens, and then presenting it. And then, of course, like everything else, we're either using the client's project management tools if they've got it, or we're using our own. Tracking these month over month and saying, hey, you're 25% complete on this one now. You're going to start to see some realization as we get into the 50 to 75% complete.
And I appreciate that, because in the work that we do, there are KPIs that operators will use to run the day-to-day that are often different than the KPIs we would use to measure the transferability and or the valuation, or collectively both, in that business, right? So, EBITDA, I mean, I have this license plate on the desk here, and it's an acronym, earnings before interest, taxes, depreciation, and amortization. Not everyone knows that, right? And but that's a key measurement that we use in our industry to measure value, right? Not the only methodology. There's several, if not, actually there's dozens of methodologies to measure the value of a business, but this is one that is used. And we have never stepped into a company that's operating the day-to-day based on a measurement of EBITDA. It's usually always feeding EBITDA or leading to that conclusion of a resulting equation, right? But never do you see the production guy and the sales guy, all right, well, our EBITDA target this month is X, right? And it doesn't have to be, because there's our influences upon EBITDA that come from a variety of KPIs depending on the industry, as you described. And what you measure in healthcare is not what you're going to measure in manufacturing. What you measure in manufacturing is not what you're going to measure in engineering, right? They're different measurements that need to be made. But how do you get those stakeholders to participate in either replacing KPIs or adding KPIs? And then further, I mean, it's an art what you do, because there's no playbook on here's how you get a human being to change their behavior. There's not one book that tells you that, right?
Right.
How do you do it? How do you approach that?
So you're absolutely right. Like, project leadership is like volunteer leadership, servant leadership. You're relying on your ability to influence, your ability to sell, your ability to create a vision, an idea. And what I'm doing is I'm looking at these individuals. They're there for a reason. So first and foremost, myself and my team are recognizing why they're there. They're an expert in their space, acknowledging that.
Yes.
And then starting to introduce the new ideas and new concepts, and saying, based on your 20 years of experience, when I say A, B, and C, what do you hear? And so I'm getting them involved right at the very beginning, edifying their experience as we go. Yeah. As soon as you do that, then all of a sudden the new ideas are kind of their ideas. And once they're their ideas, they're sold.
Yeah, because you take ownership. Naturally, exactly. we will take ownership of that, right? And without that ownership, you lose that accountability and even that drive that we need from all players on the team. Especially in a company, right? At times you'll have two experts in the same area, but that's usually a global company that's spanning geographies that need multiple experts in the same industry in different geographies, right?
Absolutely.
But in a local geographic company, you don't typically find two experts, in one company. But
you usually have your lead and then their secondary.
Yes.
You kind of get into that. And
exactly.
The two of them have already come to the minds themselves already.
Yeah.
So they kind of speak as one voice, anyways.
Yeah, that's fantastic.
Yeah.
So as we move along here, I have a couple more questions for you, because this is fascinating, and we, as you described, it's you're working to identify those challenges or those hurdles that could impede the growth from a valuation standpoint. And that's important in the work that we do, because we want our clients fully prepared once they come to the point of a transaction or a triggering event for that transaction. We want them to know, like, okay, I could feel confident, I could be confident, we can make it through a due diligence process. Here's our systems, here's the people managing those systems, especially when the leadership or the stakeholders are exiting the business, right, upon sale.
Right.
Because what I find in the work that we do, and we could cure this if there's a perception that certain leaders or key stakeholders need to remain with the business for a transitional period, we could arrange for that. We could structure the deal so that it accommodates for that. But the goal is to not have to have me and our firm, accommodate those sorts of perceptions of risk, because ultimately, when you look at the math, it diminishes valuation, or it creates a need for less desirable terms from the seller side of the table, right?
Right.
And you see this all the time, I imagine.
Yeah, you do. And then, so obviously the path that we're in is everybody's exiting at the same time.
Yeah.
And as a result of that, creates its own little challenges as far as timing. And, I'll think that we need to do something, we need to do A, B, and C. And they're like, well, I think we want to do B before C. Well, why do you feel that way?
Yeah.
You'll be surprised that when you get into looking at a list of projects or a list of initiatives and things like that, we get the pet project syndrome that pops up every once in a while. It's something they've always wanted to do, and now the flavor is we're doing a bunch of these projects. Well, let's do this one we've always wanted to do.
Yeah.
Sometimes you're going back in and saying, yeah, but it's not going to give you the result that you're looking for at this point in time.
Yeah.
I liken it to your home. Your home. You're selling your house in 6 months' time. You're told, take all the carpet out, put it in hardwood. You've always wanted Italian marble.
Yeah. Yeah.
Now's not the time.
No, it's not the time. Yeah.
Hardwood to do. Hardwood gives you the best. The best dollar.
Yeah,
So.
I know exactly what you're saying. Something that ultimately appeals to the intended target for that business, or in your illustration for that home, right?
Exactly.
Yeah, it's a good way to put it, because it makes a lot of sense. So when you think about the possibilities, right? How do you achieve an effective program or project management? That plays this critical role that we're talking about, right? And we kind of touched on it just a moment ago, but in the perception or in the eyes of the investor, right? Because if you look at this with the end in mind, and that ultimately is if you're the business operator and owner,
Right.
like, to say it bluntly, like, I don't really care what you think about your business. It's if you're going to market, how does the world perceive you, and specifically, how does the investment community perceive you? And as harsh as that may sound, like, I certainly care about the individual, right? But if their perception, or if their priorities, to your point, right, those pet projects, become your priorities as the advisor, you would not be as impactful on that organization versus following what you have designed to do in these companies.
Absolutely. Yeah. And that's where the tough conversations come in.
Yeah.
You have to, it's a little bit of a letdown sometimes, but you've got to do it.
Yeah.
And what I've found is once we get 1 or 2 months into it, and everything's starting to flow, and everything's being tracked, and our project metrics are being tracked, and we're looking at risks and issues and dependencies across all of them, and then I'm looking at it from a portfolio holistic view.
Yeah.
That seems to settle down at that point. It's soon forgotten that, hey, I really did want Italian marble.
Exactly, right? Yeah. Exactly. Put the Italian marble on the next project.
It's done.
I think that when you're able to open the eyes of stakeholders and companies and show them, what those perceptions are, it allows them to take, like you were saying, their creative thoughts and their priorities, right, and rolling those into the overall strategy. Because let's face it, I mean, they're 10, 20, 30 years into their profession. They've seen it as well, right?
Yep.
So you value that, and I love that you value that, and you speak with each of these individuals, not just to appease them, but to truly extract from them, the true impactful ideas that they have on the organization, and then putting them into that priority list that ultimately drives the strategy, right? How long do these strategies typically take to implement for you and your team?
We've done some that'll take a matter of a couple months, and then others go 9 or 12 months, depending on what it is. If you're obviously if you're overhauling a complete IT system, that's going to take longer.
Yeah, it will.
Implementing new software, that's going to take longer as well. So it's all dependent.
Yeah.
But one thing that came to mind, when you mentioned stakeholders, you'll have a habit of looking at a person and saying, this is a key stakeholder in this project. Well, when I look at stakeholders, It sounds funny, but I look at them with a bit of a matrix or graph on their face. I'm looking at every single stakeholder under two things. What is their level of influence and what is their interest? Because when you start to look at a stakeholder that's got high influence, low interest, you treat them differently than a stakeholder that has high interest, high influence. And you've got to, so the stakeholder team, you got to kind of compartmentalize them as well too, to figure out, well, who's my champions, who could be a negative stakeholder, who's going to be a fence sitter, and then that's the way you kind of, when you start managing that group together, you can get the projects move forward a lot quicker if you've kind of settled those folks down.
Because not to put another layer of complexity on this, but to put another layer of complexity, I mean, from a cultural standpoint, how do you see that play out? Because we're talking, systems, we're talking about, project management systems and methods, but when you layer culture, if you were to graph each of these, right, do you find that they ebb and flow together, or are they crossing on a linear graph chart, if you would?
I would say that they're ebb and flowing together.
Yeah. I expected you to say that. That's
and
interesting.
they have their moments.
Yeah.
Obviously, when you first go in there, it's a little bit of chaos.
Yeah.
Culturally, people are like, "What's going on?" They're not too sure. What
Yes.
are we doing? Give it a couple months, and then we're starting to all kind of get our synergy happening.
Yeah, get the synergies happening.
And basically, going towards the common goals.
Yeah.
And especially when you start tracking it and people see, like we use dashboards a lot. So people are looking at the dashboards, looking at the tracking, going, oh, okay, I see what's going on now.
Tangibly see it.
Exactly. Make them part of the vision. Make sure that they can see your vision, and then they typically buy into that.
It's satisfying as a human to look at a dashboard, but the impact that it has on the business, the production of the business, and ultimately the valuation of the business, I mean, is rewarding. So you want both satisfying and rewarding, right?
Exactly.
And so with what you're doing, you're providing both.
Yeah.
Yeah. I love that.
Yeah.
Well, let's continue on, because this is information that I think most founders and entrepreneurs think about, but they don't necessarily follow through, or even if when they do, they're still trying to understand, all right, what's the value of this investment that I'm making, or, because it can feel disruptive at first, and that's not a bad thing, right? Because you're not in there to pat everyone's back and say, all right, keep doing what you're doing,
Yeah, exactly.
I mean, they can hire anyone to do that pretty much, right? Mostly. But you're going in there and you are being disruptive internally, but we talked about, inside sales or outside sales, right? But you kind of redefine inside sales to me, because you're inside selling the people within the organization on concepts or processes or procedures and systems that, I mean, wouldn't you agree? Likely they've all thought about these things along the way, but they just didn't know how to.
There's a lot of that.
Yeah.
You start to bring it to the table, and like, we thought about that 6 months ago. They'll look at each other. When was the last time we talked about that? Well, now it's real.
It's go time.
And I love it when they say that, because I'd be like, okay, so you thought about this 6 months ago? Can you remember what you said?
Yeah.
Let's go back 6 months now.
Yeah.
Talk to me. What was said? What did you like about the idea? What didn't you like about the idea? What was the risk you identified at the beginning?
Yeah.
You get a lot of good information of that, and then immediately they're always on board because they already thought about it 6 months ago. So you've got that kind of working to your advantage.
It was a good enough idea to think about.
Yeah.
But no one. It sounds like maybe they didn't do a good job at executing, or no one even took the time to execute on it because they were just so busy doing what they're doing.
Busy doing what they're doing, or not sure we want to spend these dollars right now.
Yeah. Yeah.
Well, now when you're looking at doing an exit, doing a merger, whatever, you're now taking a look at, well, what are we going to spend to make this even more valuable? So it's kind of like it breathes new life into some of these ideas that have been kicking around for 12 or 6 months.
Yeah, and it re-energizes the team, which is needed in terms of energy to drive forward, right, and to implement these things.
Yep.
Yeah, that's really powerful. It really is. And it's those, going back to those dashboards for folks to be within an organization, to be able to see that, you know, it is like I said, satisfying, but it also, it allows them to see their contribution to the organization in real time. It's like, oh yeah, that was my idea,
Exactly.
or my thought, you know, ultimately led to why we're doing this in that certain way. Yeah, that is cool.
And when we come in with our tools, I'm very transparent. I'm as transparent as the organization will let me.
Yeah.
So, you know, if it's a dashboard, it's likely a link that anybody can look at.
That's important.
Because you want them to see that. You want to say, well, that's my project.
Yeah.
Oh, look what it's doing.
Yeah. You certainly don't want a dashboards of everyone's salary.
Yeah.
That's one dashboard you want to stay away from, right? Yeah. No, and rightfully so, right? We all have different contributions to organizations, and that's just a distraction. You know, I think we could all agree on that. But you know, in some of the closing comments and remarks here, you know, we talked about how you go in and how you engage everyone, stakeholders, leaders, operators, and that's important, and that is the art of what you do. I know it's the art in what we do as well, because there's every case study is different. You know, you have, you know, humans are the same wherever you go, you know, but there's different type of human behavior within an organization, and depending on the mixture of those personalities, right, and strengths and experiences, it's pretty powerful when you think about it. I mean, if you were to take a company and try and replicate it exactly the same way, it's hard to do, because you would have to have the exact same people, right, doing and working on the exact same projects. You could replicate it within the organization, but to replicate it and create a competing organization, it'd be hard to do it without the same people.
Because you know, there's a whole other layer too of what happens when they leave the office, and how does that impact you know, how they perform, how they act when they're in the office. And you know, it's not always sunshine and rainbows and everything too. There are times when these announcements are made and people decide that's my time to go. And you get key stakeholders that just decide, I'm done.
And I might be killing this movie for a few people, but I just took my family to see Wonka over the weekend. And the mother who passes in the movie, she leaves in the chocolate bar. She tells him, Wonka, there's one secret ingredient in my chocolate. And she never told him before she passes, but in the end of the movie, he unwraps the chocolate bar and it says, the secret ingredient is not in the chocolate, it's who you enjoy the chocolate with.
Interesting.
And it kind of speaks to this, right? It's like, okay, yes, you could have all these ingredients, all these systems, but it's like, who are you running this company with? Who are you running these systems with? And just to connect those two, it's like, it's powerful though. It's because there's no magic pill.
No.
There's no magic ingredient.
There's no book. There's no training. There's no. Exactly.
It's a collection of, right? Yeah. So sorry to ruin the ending to Wonka, but it's still, we all know where that movie ends, because it's like a prequel to Willy Wonka, right?
Exactly.
So go see it.
Will do.
It was good. So, you know, with that said, though, you know, we walked through and talked through a lot here, and you know, but you know, those that are looking to or contemplating to, you know, actively engage in evaluation or in an exit plan, you know, how can one focus on project management, you know, process improvement, and strategic? We talked about, or we haven't talked about project recovery, because that, you and I both know, significantly impact the success of that exit. And I want to layer something on top of that is the deal terms, right? So if I could say it this way, what you and your firm aren't able to complete within the organization, I can tell you right now, always ends up a point of negotiation in the deal terms from the deal side, right?
Right.
We talked about retention. We talked about, you know, who's the glue that keeps the organization together, you know, and ultimately you want, I like what you said earlier, and if I heard you right, you said you want to build a program so that everyone can exit.
Right. Yeah.
And when you do that, right, what that means in the deal world is that if everyone could exit, then guess what? Everyone could exit, and the perception of risk of anyone exiting is low, because if they're acquiring, whether it's intellectual property or a system or a method, that's what you're coming in and you're making sure that is there, whether those individuals are there or not. And
Right.
so, because we will all exit, some will retire,
Yep.
some will move on.
Yep.
Unfortunately, some of us will leave this earth. We don't know when, but we will. But I love that for that reason, because if you were to say, Brian, we have this case, they want to go to market, and we designed this plan so everyone could exit, all the stakeholders could exit.
Right.
You know what I'm going to tell you? I'm going to say thank you so much. We can now pursue, investors and buyers in the marketplace, and we can enable them to pay all cash for those types of transactions, right? Because that's what it comes down to. Because those deal terms are ultimately the resolve for a perceived risk on the investor side. Right. So, but let's close out with a success story of, you come into a company, you've implemented, maybe it was a merger or a strategy for a roll up. I mean, how did that play out?
It's and kind of going off the whole everybody exiting, there was a firm date.
Okay.
There was a date that was established. So we have to come in, and you have to treat those projects as time bound. So if you think it's going to run over, you're applying more resources. You're
I see.
putting more dollars, more people to it, because your time is fixed. And we had one that basically everything was done from a project management perspective. All the projects were closed about 45 days before before the actual date. So it was great. It was just like, okay, we're done. Now what?
Exactly.
It's like
on to the next.
They still had 45 days to go before they were just getting into the closing stages. So that's good. I like that. I also like the fact that particular one, each quarter we were evaluating the projects, and we could see that they were getting the return on investment for the money that they were investing in having the projects managed for them, as opposed to them trying to do it themselves with the skeleton staff. They were getting their return on investment on that. So it was just a good all around, just a good feeling.
Yeah. And I mentioned to you earlier, I mean, if you were to apply an ROI to the work that you're doing, I haven't done the work yet, but I would imagine once you calculate that, it's going to be in the hundreds, if not thousands of % return on the work that your firm is doing, because this is the part of the transaction when it gets to the a transaction trigger, to be able to represent an organization that has implemented your work and your systems. I can tell you right now, it's going to be received so much better from the investor standpoint, because they too have a time frame in which they're coming into that investment and also exiting that investment. When you look at private equity generally, I mean, there are some unique firms that don't have a particular due date, right? They could hold a company indefinitely, but most firms do have a deadline, right? Because they're raising capital, and that capital has to be not only deployed but then returned within a, let's say, 3 to 5, maybe 7 year window.
Yep.
And if they don't, that's when, from a capital perspective, can cause those investors to behave differently than what they otherwise would behave in a setting where they are meeting those deadlines. So it's impressive to me that you can come in all within a 12-month window, right? No more than a 12-month window, and do the work that you're describing and pinpoint perfection of within a 45-day due date. That's impressive. That's impressive.
Yeah, it was good. And when you just realize right from day one you
Yeah.
are essentially running a time-bound project. You know, Y2K was a time-bound
Oh, yeah.
project.
I remember
you know,
that.
Exactly. So
Yeah.
you can't move
Yeah.
that. When you know that right from the very beginning, you set your teams, you set your monitoring, you set your everything up to that.
Yeah.
And it's just,
Yeah.
as opposed to starting and then somebody coming and saying, oh, by the way, this is now your due date.
Yeah.
So,
I haven't thought about Y2K in a while, but it's certainly motivated.
it is the best example of
it
a project
really
that
is.
could not even, a fraction of a second could not move.
Yeah.
You know.
Yeah. That's so true.
Yeah.
Well, Brian, thanks for being here
Thank you.
with me and on the podcast and sharing your wisdom, your experiences. I can definitely see how our firm and your firm could work together in the future. The work that you're doing is not always prioritized, but my hope is, for the sake of founders and entrepreneurs, that they take these nuggets of information that you shared and work hard and carefully to advance their businesses as they're looking to grow, scale, and ultimately exit their companies. And if a client that we have is ready for that exit, great. But this podcast was designed to help those that are 3 to 5 to 7 years
Yep.
away, and I would even say even a year away, right? I'd say 1 to 7 years away from an exit, because if we could empower them and enable them to implement systems or bring on tools or professionals to improve and enhance those companies for the market, everybody wins, and that's our goal. I mean, ultimately, sincerely, truly, that's our goal for them, because every time our client wins, we win alongside with them. So we become one of their biggest cheerleaders. But we wanted to be more than that with this podcast. Of course we'll still cheer them on, but we also want to coach them and guide them and lead them to professionals like yourself. And so what we'll do in this recording, and when the podcast launches, and obviously if you're listening, it's already launched, but we will have links to contact you and your team. So if anyone's interested in this sort of work that you do, they can certainly reach out to you and get ready to be amazed, because what you're going to do for them is very powerful.
I appreciate that, because everybody is experts in their own
Yes.
field. We just
Yes.
happen to be experts in the art of organization, prioritization, and just getting it done.
That's 100% right. Yeah. Well, Brian, thank you for being on this episode.
Thank you for having me. This is great.
Of course, we'll stay in touch,
Yep.
and we'll keep a pulse on any future projects that we could work on with one another, ultimately for the enhancement of those listening in. So, thank you, Brian. Thank you for making your way out. And thank you for joining us on another episode of Private Capital Mastery. Make sure you tune in next week, where we are going to unpack and unveil more of the playbook when it comes to exiting your companies. Thank you for being with me here. I'm Brian Franco, and I'll see you soon.